All right, I had a question or a request from a student to touch on a few of the final slides from chapter 5 related to gifts. I won't spend a ton of time on it. There's not that many slides, but some of the issues around giving gifts, again, gifting is before death, transfers occur, or bequests occur after death, and we generically call transfers is the big heading. So before death, it's considered a gift. After death, it's a bequest. So when we're talking about gifts during life, what you give up when you give a gift during your life as the donor is the donee doesn't enjoy the step up that you can get after if you give a gift in death instead of giving a gift during your lifetime. And oh, by the way, that's also in that article that there's this risk that that step up in cost basis could be taken away in the next iteration of changes that happen. So it's an interesting time for you to be learning estate planning because much of what you learn, of course, as is the case with almost everything in personal finance, is subject to change. I mean, some of the basics on investing and some concepts around time value money, those aren't going to change, but taxes are a constantly shifting landscape. So when we're talking about giving gifts during your lifetime, note that the donor is going to be giving the donee their own adjusted basis and the holding period. And just so that we are on the same page, if you owned 10 shares of Tesla, and at the time you paid $1,000 for those shares of Tesla, and then over time, those 10 shares of Tesla grew to be worth 10,000. And you're like, hey, I think I'm going to give these 10 shares of Tesla stock to my kid as a wedding gift. Well, way to go. Give your kid the gift. What the kid is going to get is the 10 shares. Your gift value is $10,000. The kid, if they sell it the day after they received those shares of stock from you, they're going to get $10,000 minus the capital gains tax. I'm sorry, minus the capital gains tax that would apply on the $9,000 worth of growth. So what's $9,000 times 15%, assuming a long holding period and a kid that didn't have a bad tax rate? 9,000, you probably did this in your head already, 0.15. So 1,350. So the kid would net 8,650. And that's if he sold it right away. So the kid wouldn't necessarily have to sell this stock right away in order to enjoy it. He could just hang on to it. But what he didn't get is the step up in the cost basis that he would have gotten had you waited to give him this gift until after you died. So when we talk about the basis, we're talking about what you paid for it on an adjusted basis. So there might be some other costs associated with the acquisition, but to keep it simple, the basis is what you paid for that thing. And if you hold it for less than a year, you're not subject to capital gains tax, you're subject to regular income tax, which is a much worse rate for most people. So short-term holding period, income tax. Long-term holding period, capital gains tax. And if you give a gift during your lifetime of stock, that short-term holding period or long-term holding period goes with it. So they essentially just stand right in the shoes that you were in, which is if you bought it 8 months ago and the date that you give it away, the new owner also just keeps your old date that you purchased it. So again, keeping whether or not it's a short-term or long-term holding. If they want to continue to hold it until 1 year is up, then they'll enjoy the long-term capital gains tax rate. But this concept comes back into play when you're trying to figure out, well, what the heck should I be giving away? You know, what's a smart thing to gift? And that's what this chapter also attempts to show you is what are some of the strategies to make efficient, smart gifts? And that little example I just showed you, if your kid is in a low enough tax bracket, he might have no capital gains tax on that gain. So if your kid is like maybe in grad school when he gets married, he's not making any money, maybe neither is his spouse, you could give him that Tesla stock, you could sell it and owe no capital gains tax. We'll see how long that rule lasts. It's probably also in the chopping block. Okay, so there is an exception to this rule, and that's all about if you are giving a gift that is at a loss. So if the fair market value of the asset given is less than the donor's basis, here's the short answer: don't give away a holding that you have that currently has a loss, because you could benefit from that as the owner. There's a fairly dumb tax calculation that you need to use for how we adjust the basis on that. And I'm not going to walk you through it. And I'm not going to test you on it. Just know this. I will test you on this. Should you ever give stock that's at a loss? That would be the, and if it were an essay question or a short answer question, why? And the why is, if you were to sell a stock at a loss, you could enjoy that capital loss yourself. And also because the person that's receiving the gift doesn't get to enjoy the loss. If that were the case, if you were able to gift a loss, people would be buying that from you. They'd be like, please, can I buy that stock that's at a loss from you? Let's call it a gift. Because if somebody's in a bad tax bracket, they really enjoy losses. I love losses. All right, so second exception. When gift tax is paid on appreciated property, we've talked about that already a little bit, but again, I'm not going to test you on the calculation of income tax issues when gift tax is paid. Okay, but I do want to talk about gifting strategies. Because if your goal is to be efficient with your gifts and be smart with your gifts, you want to be thinking about your own personal situation. If you're the donor, donor goals. If you're generous, you want to maximize the gift efficiently, which seems kind of like a goofy. So you don't want to be giving, so you want to give $1 million away to a charity. Do you want to give them cash? Do you want to give them appreciated stock? Or there's this thing called a qualified charitable distribution out of your IRA or your 401k when you need to take an RMD. I probably just use like 4 terms that you might not be comfortable with, but the answer is if you're going to give a gift to a charity, of these 3, cash, a significantly appreciated stock, or a qualified charitable distribution out of a qualified plan, the answer is this one is the most efficient. And we'll learn why. I will drone on about this because this is maybe the best thing that you could do for a client is if they're feeling at all charitable, have them wait until it's required minimum distribution time. And we're gonna get a whole bunch of money out of their tax regime, assuming this also survives the test of time. And they're gonna get to make a big fat gift. But assuming they don't have any kind of IRAs, if they don't have any qualified plans, then the difference between gifting cash and appreciated stock is appreciated stock is going to be a much smarter gift to give, because if you were to have sold it yourself, what's its real value to you? The real value of appreciated stock to you is no different than the math I just went through for your kid. So again, if we're going to give Tesla stock, you have $10,000 worth of Tesla stock that you could gift directly to a charity, or you could sell it yourself minus the tax and give something much less than $10,000 to the charity. You'd be better off just gifting them the stock directly, getting the entire write-off for the $10,000 and not worrying about the tax, because you are gifting them the stock. You're not selling it first. You are transferring that stock to the charity. That is a much smarter gift because that stock is, at $10,000 is worth less to you because of the tax than your cash. So if you've got $10,000 worth of cash sitting in a bank account versus $10,000 worth of Tesla sitting in a brokerage, here's another test question. What's worth more to you, assuming you have enough income to be subject to capital gains tax? What asset do you want to keep? $10,000 worth of cash or $10,000 worth of Tesla stock? It's kind of a dumb question. I should reframe that. $10,000 worth of appreciated stock to you is not necessarily today worth $10,000. It's worth $10,000 minus the capital gains tax on the gain. Versus a bank account with $10,000 in it. So when you think about gifts that you want to give to a charity, you're thinking about which one is going to get me the most bang for my gifting buck. So that's charities. And we have a whole chapter on charities, so we'll really go after that. But let's think about all the other people in your life, the ones that you're not getting any kind of charitable deduction for. What kind of gifts do you want to give them? Well, we talked about the kids that have low tax brackets. So this idea of gifts of appreciating property, charities are a good recipient for those, as well as people in low tax brackets. That might get the 0% capital gains tax rate. And I'll let you Google what that entails. So there are some people who don't have to pay any tax on capital gains. They would be good recipients of appreciating property. And then of course you can give a gift to your spouse, and you know that's a freebie. And then gifts to minors, because they're minors and can't really receive and manage gifts on their own, you'd have to use the trust to give it to them. So the slides that talk about these strategies, I just want to touch on a few of these. We talk about single party strategies. We're talking about from you to another individual. And you're trying to figure out which is the best gift to give. You probably want to use a balance sheet approach to identify, what is your goal? Because the other goal besides maximizing gift efficiency is, if I'm really worried about estate tax, if I'm questioning, will I owe estate tax? Maybe your goal is to minimize, your estate tax. And maybe hey, I've got enough money in my retirement accounts that's going to carry me through to my last day on earth. I have all of these other assets that I've accumulated. Maybe I inherited them myself, and I want to get them to my heirs as efficiently as possible. And their value today versus their value in the future when I'm upon my death, and I have to make some assumptions about how long I'm going to live, let's say age 95. If I'm 65 today and I've got 30 years worth of growth that could happen between today and when I die, who knows what that asset might be worth, but we can make some general assumptions. We know that cash doesn't appreciate much. Right now, you probably if you get 1% on your money market account, I'm shocked. If you're beating that, please tell me, send me a text. If you own real estate, depending upon the kind of real estate, it'll grow, but probably not by much. Bonds, also lower growth, typically. And then you move into large cap stock, then followed by maybe mid cap, small cap, and maybe emerging markets, et cetera. So you have these assets that start sort of, as slow growers, maybe real estate's like this, maybe bonds are like this, large cap, mid cap, small cap. It's all about the slope of the line. Which is going to grow the fastest? And that's the asset that you want to get out of your estate if you're concerned about trying to minimize your estate tax bill. Because if you today owned all of these different asset classes in equal amounts, today they are all worth, $1 million, $1 million in cash, $1 million in real estate, $1 million in bonds, $1 million in large cap, et cetera, et cetera. If you use some standard assumptions about growth, and of course we're guessing, we have to make assumptions all the time in financial planning. You're going to assume that the small cap and emerging market assets, or maybe even your own closely held business, is going to grow the most, and it's going to suck up the most room in your estate. Again, if you hold these assets to death and own them in the same amount that you own them today, they're going to grow the fastest on this end of the scale. And so getting rid of these are your candidates for trying to reduce estate taxes. So when you prepare this balance sheet with a forecast of what's likely to appreciate the most, that's what you're on the hunt for. And trying to remove those highly appreciating assets from your estate is the goal. Now, if you're about to die, you're going to change your strategy. But we're going to talk about giving gifts close to death in the next chapter. It's not smart. And for multi-party strategies, never giving a gift that's at a loss. You sell it yourself instead and enjoy that loss, and just either give a different asset or give the cash that resulted from the sale of that asset, whatever it was. And, if you really want to benefit the long-term wealth of your, extended family, you're going to give the gifts with the greatest appreciation potential to the youngest person, because your goal is to create some kind of a legacy. Then you want this gift to sit with them for as long as possible. So the younger they are, the longer, in theory, they'll hang on to it, and the more appreciation they'll enjoy. And gift appreciated property to charities. I would say also, you could also gift appreciated property to your adult kids who are in low tax brackets if you didn't have a charitable intention. And then this whole idea of gifting income producing property also requires just a tiny bit of explanation. If you own a duplex that spits out, let's say $12,000 a year worth of net income, maybe the duplex itself is worth, I don't know, in this town, what do you think? I'd say $300,000 for a bad duplex. It's in disrepair. So you want to gift this asset. It's like, who should I give this asset to? Well, that income, that $12,000 a year worth of income from the duplex is taxed at regular income tax rates. So the person with the lowest marginal income tax bracket is the smartest one to give it to. In the example, we end up giving that to, I think, an old person, because we're assuming this old person, which I think is a little offensive, is the person with the lowest amount of taxable income, which I hate to tell you, but if you're getting required minimum distributions from your IRAs and 401ks, your tax bracket is bad, but whatever. We're going to go with an old person that doesn't have a lot of taxable income already. They're the ones that it makes the most sense to give income property to. A charity is the smart one to give appreciated assets to. It should also include a qualified charitable distribution, but we'll get to that. The donor should keep property with fair market value that's less than the basis. So if they own something that's at a loss, keep it. And the youngest person gets whatever is expected to appreciate the most. These are general strategies. You're going to find exceptions to this where people are like, hey, I want to give this specific thing to this specific person for this reason. It's not efficient. I don't care. And you'll get answers like that all the time on a variety of topics from clients. The other strategies that we mentioned last time that I think are super helpful, because they don't count towards your lifetime exemption limit, is to make qualified transfers. These are when you write a check directly to a school for tuition or to a medical institution for medical treatment. Those they don't land on a tax return. They are very effective ways of reducing your estate. Of course, you're writing a check, which means you're giving cash. You also want to use your annual gift exclusion each year. If you're generous and you want to be generous, and you're like, well, I'll wait till I'm dead to give things away. It's like, well, you could, or you could start gifting now and use that annual gift exclusion and make the most of it during your lifetime. We'll talk about the marital deduction in future chapters, but as you know, the marital deduction is a freebie. You can give your spouse as much as you want, because it's really just like putting it from one pocket to the other. It's not thought of the same way as giving other gifts. And then using the lifetime applicable gift tax credit equivalency amount. That's what this article was all about. It's like, hey, everybody's worried about this. You know, this thing is going to go away. So let's maximize this 11,580,000, which of course is going to, if nothing happens, if, you know, Biden doesn't change it or Biden doesn't win, and this is allowed to continue on its current path, every year it's going to go up a smidge until the date it's expected to sunset on December 31st, 2025. Other gift strategies include, you know, knowing that if you do blow by this 11,580,000, if you end up paying gift tax on that, it reduces your estate as long as you're giving gifts more than 3 years before you die. That's going to twist your brain into a pretzel if you try to think about that for too long right now. But for those of you who've already absorbed this material and are thinking about it more deeply, and you're like, okay, what can I do today to reduce my estate? Well, you could just live large, right? Just enjoy your life. If all you're worried about is reducing estate taxes, just spend your money. That's what the IRS wants you to do. That's what the government wants you to do. Just spend your money. I mean, they want you to take care of yourself, right? But they also want you to spend your money. And so if you stop hoarding and start spending your money, hooray, we get to, you know, have a robust economy. And part of that spending your money might be paying gift tax on gifts prior to 3 years of death. So maybe you'll blow by this $11,580,000 worth of gifting, and you'll have to pay tax on the gifts that you give. But that's another way of reducing your estate. The big benefit of giving gifts while you're alive versus bequests, that's all summarized here. Now, this list of possible transfers that can help reduce your estate, obviously support payments like alimony, maintenance, child support, you know, that all happens when you're alive. There might be some deal that, you know, if you get divorced, you might have to carry life insurance to pay to your former spouse to maybe true up any ongoing maintenance deal that you made. But generally, you know, support payments that you make during your lifetime reduce your gross estate. You don't make support payments at death. Same thing with qualified transfers and obviously the annual exclusion. You get to use that annual exclusion every year. And if it's a use it or lose it proposition, and when I'm talking about annual exclusion this year, I'm talking about the $15,000 per person that you can give to as many people as you want. And gifting future appreciation on assets transferred. It's what we were talking about with the, you know, assets that if you give today and you get them out of your estate today, you've essentially frozen that asset value in terms of gifting. But the value to the person who received it is, you know, who knows how much, if they hang on to it, it'll appreciate a lot. Okay.